Hello, and welcome to another episode of Deep Dive into Finance. This is your go-to place for breaking down complex financial concepts into simple, digestible bites. Whether you're a seasoned investor or just starting your financial journey, understanding the lingo is key, and it's not as intimidating as it might seem. So, let's get started. Today, we are going to unravel the meaning behind two very common terms in finance: bearish and bullish. When it comes to finance, you'll often hear the terms bullish and bearish, but what do they mean? These terms are more than just Wall Street jargon. They're used to describe market trends and investor behavior. Picture this: a bull charges with its horns up, symbolizing rising prices and positive sentiment. On the flip side, a bear swipes its paw downward, representing falling prices and negative sentiment. When someone says they're bullish, they believe that a particular asset, sector, or the overall market will rise. Conversely, if they're bearish, they anticipate a decline. These terms aren't just for the financial elite. They're for anyone who wants to understand the ebb and flow of the market to make informed decisions about their investments. Now that we've set the stage, it's time to delve deeper into these concepts. Let's start by understanding what bearish means. Imagine a bear. It swipes down with its claws, right? Similarly, a bearish market trend means the market is on a downward trend. But let's dig a little deeper to understand the full picture of what we call a bearish market. Picture this. You're at a bustling market. The air is filled with the chatter of buyers and sellers, but something is off. The vendors, usually vibrant and eager, are less enthusiastic. They are dropping their prices rapidly, almost desperately, hoping to make a sale. The buyers, on the other hand, are wary. They hold back, wondering if the prices will drop even further. This, in essence, is what a bearish market feels like in the world of finance. When prices of stocks, bonds, or any other securities start to fall, and the overall market sentiment turns negative, we say that the market has turned bearish. The term is derived from the way a bear attacks its prey, swiping its paws downward. This downward movement is symbolic of the falling prices in a bearish market. Investors and traders in a bearish market expect prices to continue falling. This expectation can cause them to sell off their holdings in an attempt to avoid further losses, which, in turn, can cause prices to fall even more. It's a self-fulfilling prophecy of sorts, where the pessimism feeds onto itself, creating a cycle of falling prices. A bearish market is not just limited to stocks. It can apply to anything that is traded, like commodities, real estate, foreign exchange, and even cryptocurrencies. It's a universal term used across various asset classes to denote a downward trend. But remember, a bearish market is not necessarily a bad thing. For some, it could mean an opportunity to buy assets at a lower price. It's all about perspective and strategy, so that's the gist of it. When you hear someone say, "the market is bearish," you now know they're talking about a market where prices are falling and the sentiment is negative. In short, a bearish market denotes pessimism and falling prices. On the other side of the spectrum, we have a bullish market. Picture a bull thrusting its horns up into the air. That's a bullish market for you. A bullish market is one that is on the rise, with prices increasing. This is not some random surge, but rather a sustained upward trend, where the overall economy is growing and stock prices are rising for an extended period. Picture it like a wave that continues to swell, carrying all the surfers, here the investors, on a joyful ride. The key here is sustained and extended. It's not a flash in the pan, but a steady climb. Now you might wonder, what drives this upward surge? The answer is confidence. In a bullish market, investors are confident. They believe the prices will continue to rise, and this belief fuels their actions. They buy more stocks, expecting that they can sell them later at a higher price. This buying action, in turn, drives the prices up even further, creating a self-fulfilling prophecy. Let's consider an example. Imagine a tech startup that has developed a revolutionary product. Investors hear about it and believe it's going to be the next big thing. They start buying stocks, pushing the prices up. As the prices rise, more investors jump on the bandwagon, further driving up the prices. This is a classic example of a bullish market in action. However, keep in mind that a bullish market doesn't mean that every single stock is on the rise. It's more about the general trend. If the majority of stocks are increasing, that's a bullish market. Also, remember that markets are cyclical. They have their ups and downs. A bullish market doesn't last forever, but while it does, it's a great time for investors to potentially make a profit. So, A bullish market represents optimism and rising prices. It's a time of confidence and growth where the financial waters are warm and the surf's up for investors. It's a time when the bulls are in control and everything's looking up, quite literally. Now that we understand what bearish and bullish markets are, let's discuss why they matter. Bearish and bullish markets don't just exist in a vacuum. They have real impacts on the world of finance, and more specifically, on the decisions investors make. So, how exactly do these trends affect investor behavior and investment strategies? In a bearish market, the overall sentiment is one of pessimism. Prices are expected to decline, and this expectation can cause a self-fulfilling prophecy of sorts. Investors, fearing losses, might start to sell off their holdings. This selling pressure can drive prices down, leading to a market-wide downturn. For investors, a bearish market may signal a time to exercise caution, to reevaluate their portfolios and perhaps shift towards more defensive investments. It could be a time to look for undervalued stocks that may rebound when the market turns around. On the other hand, a bullish market, characterized by optimism and rising prices, can create a different kind of environment. Investors, anticipating gains, start buying, which pushes prices up even further. A bullish market might signal a time for investors to take on more risk, possibly investing in growth stocks that could provide substantial returns. It's also a time when investors might feel more confident in the market and their investments. However, it's crucial to remember that neither bearish nor bullish markets last forever. Markets are cyclical, and what goes up must eventually come down, and vice versa. Understanding these cycles and recognizing the signs of a bearish or bullish market can help investors time their investment decisions more effectively. Also, it's important to note that while these market trends can influence investment strategies, they shouldn't dictate them entirely. A savvy investor knows that a well-diversified portfolio can weather both bearish and bullish markets, and that long-term investment goals should always be the guiding force behind any investment strategy. Remember, understanding these trends can help you make informed investment decisions. So there you have it, bearish and bullish made simple. We've unpacked these terms to reveal their essence. Remember, bearish markets are characterized by falling prices and a general sense of pessimism. Conversely, bullish markets are all about rising prices and an atmosphere of optimism. These concepts are fundamental to understanding the ebb and flow of the financial world. Thank you for joining us on this financial deep dive. Stay tuned for more finance insights on our channel.